Section 1.6 of Topic 4 in Paper 8 kicks off with warrants. Now, a warrant is like an option in that it gives you the right, not an obligation, to buy. It's usually buy, it can be sell, and that's with derivative warrants, an underlying security. But warrants tend to be a longer term. Options up to 3 months, warrants 1 to 5 years. We're told there that the first equity warrants were issued in the 1980s in Hong Kong, and we'll find out the difference between equity warrants and derivative in a moment. Derivative warrants came in 1989. And as I've just said, like options, warrants give an investor exposure to the underlying asset without actually owning the securities. Now, the next point's important and has been examined. While both warrants and options are traded on the Stock Exchange of Hong Kong, warrants, which are considered securities, are matched using the Orion trading platform. That's the trading platform of the Stock Exchange, and are cleared through CCAS, the Central Clearing and Settlement System. While options are matched using not the Orion trading platform, but the Hong Kong Automated Trading Service. So automated trading, yep. And that is part of the futures exchange. So HKSI is the matching system for futures, but also traded options. Now, the matched options are then cleared through DCAS, Derivative Clearing and Settlement System, not CCAS. It's a finicky point, but so easy to examine. So just remember that warrants on underlying securities are cleared through CCAS, while options are cleared through DCAS. And also, please be aware, warrants cannot be sold short. These are easy points to come up in the exam. Okay, the two different types of warrants, equity warrants and derivative warrants. Favorite question to see if you know the difference. The main difference is that equity warrants are issued or listed by the company whose shares are the underlying asset, whereas derivative warrants are issued by a party that's independent to the issuer, usually investment bank. Holders of options, holders of equity warrants, third bullet point there, are not entitled to dividends. So no dividends with warrants, because you're in a holding pattern. You're deciding whether or not you are going to exercise. And if you exercise, the company will issue more shares. So for the company, what are the advantages of issuing warrants as opposed to actually issuing new shares? Well, new capital is raised when the warrants are exercised. So once the holder exercises, new shares go out and you receive more money. You are issuing capital. Relatively inexpensive to issue, that is the warrants. Traded on the stock exchange, providing liquid secondary market for warrant holders so they can buy and sell. Can be used as sweeteners when issuing bonds or with IPOs. So you hand out warrants at the same time that can be exercised in the future, or they can be used as a bonus to shareholders in good years. If you're short of cash, an equity warrant can be issued as the dividend in place of the dividend, and shareholder base can be broadened when warrants are exercised. So these are all advantages for the company who lists warrants. Be aware of those, easy to examine. Derivative warrants, as I said, are issued to a party that's independent of the company whose shares are the underlying assets. Majority in Hong Kong are settled in cash. What does that mean? If I exercise, I'll only exercise if I'm going to make money. That is, I have the right to buy at, say, 20 shares, while the the market price is 25. In that case, with the derivative warrant, the intermediary, usually an investment bank, will just pay you the difference of $5 rather than sell you the shares. With equity warrants, when they are exercised, then more shares are issued so that interest is diluted of other shareholders, whereas with derivative warrants, no new shares are issued, so there is no dilutive effect. Okay, we're told there that derivative warrants can be issued over assets other than securities, so currencies, commodities, and also index warrants. Basket warrants and single stock warrants can also be issued by those investment banks. Key concepts: call and put. Well, as I said, call is the most common, but put warrants can be issued as derivative warrants. Warrant price: we're given the influencers, the factors that will influence the price of a warrant. Now, these factors are the same as options, and we will cover these in a lot more detail later in topic 4, indeed in section 13. But it's the price of the underlying instrument, the actual market price, the exercise price, the time to expiry. So the shorter the time to expiry, the less valuable. Volatility, that is volatility of the underlying share price, interest rates, and dividends that are paid on the underlying asset. Expiry date of a warrant is the final date which it can be exercised. The underlying instrument is the share or the underlying basket or portfolio of shares with regard to derivative warrants. The exercise style, American or European, we've seen this earlier with the options, American style, exercised any time up to and including the expiry date, whereas European style only exercised on the maturity date. Now, of interest in Hong Kong, derivative warrants are always European style. You can exercise those on a particular day, while the equity warrants that are traded on the market are usually American style. They can be traded at any time up to and including the expiry date. Exercise price, same as options, strike price that must be paid when you exercise the option. Now, conversion ratio, this is unique to warrants. And we're told it is the number of warrants that must be exercised to convert into 1 unit of the underlying stock. So if conversion ratio was 10 to 1, that means that you have got to convert 10 warrants to be able to receive 1 unit of the underlying asset, 1 share. What are the advantages of warrants? All of this is easily examined. Warrants are higher risk, like options. They're a little bit more volatile. But what are the advantages? Gearing. You're not putting up all the money for the underlying share. You're putting up a fraction, so you don't have to invest as much. Hedging. Warrants can be used to hedge positions, same way as options, although warrants tend to be longer term hedge, 1 to 5 years, whereas options up to 3 months. Speculation, it's a relatively cheap way of speculating. Market exposure, this is where it's an index or basket. Warrants can give the investor exposure to the market as a whole or to a particular sector, and that will be of interest where you have a view on a particular sector or the market as a whole. Capital raising, when an equity warrant is exercised, company issues new shares and new funds are raised. So you don't have to persuade the potential shareholders. It's worth their while. And so automatically you are raising capital, that is the company. And improve the liquidity of the underlying stock. When derivative warrant issuers need to buy underlying shares to hedge their positions, then you have more activity in that stock. 1.6.4 goes on to look at the risks. So we had the advantages of warrants. Now we're looking at the risk of warrants. Liquidity risk. Well, the risk that an investor may not be able to readily buy or sell warrants on the market. And that happens where you've got deeply out of the money warrants. In other words, it is nowhere near worthwhile to exercise. So let's say the exercise price is 30, the current price in the market is 10. Why on earth would you exercise and pay 30 when the current price is 10? So the warrant price will just be purely time value, and the risk is the liquidity. Now, to avoid this or to reduce it, issuers of derivative warrants are required to appoint liquidity providers, market makers, in other words. And for each warrant issue, there can only be one liquidity provider appointed. And the duties of the liquidity provider are to provide continuous quotes, provide liquidity for at least 10 board lots of a warrant, specify maximum spread between bid and offer, specify in the listing document the response time for each quote request. Okay, so that has been added to reduce liquidity risk. Very specific point has been examined, not every exam, but be aware of it with regard to derivative warrants. Leverage risk, well, we had gearing risk as an advantage for the holders. The risk is that percentage loss will be magnified. So as with any gearing, if you're making money, you're not having to put as much in to make the return. But the opposite is if you lose money, that loss will be magnified as the underlying asset price moves much lower in percentage terms than the warrant price. Limited life, yes, there is an expiry date. The investment doesn't go on forever. Corporate decisions, unlike shareholders, you don't have any voting rights as a warrant holder. You cannot influence the management of the company. And then finally, there are other risk factors with regard to warrants, including interest rates, inflation, economic environment, but those are very similar to holding the underlying asset. And then we have stapled securities. Now, this is where you have two or more securities that are sold together. And the third bullet point there really illustrates what we're talking about. An example would be a company share combined with unit in a trust. So you buy and sell both at the same time. They're legally bound together and cannot be traded separately. And we're told there with the Hong Kong Stock Exchange, there will be a single price quotation for the stapled security. They do not quote for the two individual components. Not regularly examined, but a sort of one-off type of security.